Hi guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing conservative estimation of future growth rates. It's very easy to get caught up in extremely fast-growing companies and to look at them and say, okay, this company is growing at 40% per year. It can continue to grow at that rate in the future. My advice to you, and this was also Benjamin Graham's advice, if you read chapter 39 in the 1962 edition of Security Analysis, he goes quite in depth about valuation of growth companies in that chapter, specifically in that edition. And he recommends, and this is something that I also do and also recommend, that you limit your future projected growth rate of a company to a maximum of 20%. Okay, what do we mean? We mean that if a company is growing at a very fast rate, for all your future projections, cap that future rate of growth at a maximum of 20% per year. Why 20? Because there has to be some limit that we apply. There's no secret to the number 20, but we have to establish a limitation on, our growth rates at some point, and Benjamin Graham decided it was 20%, and I think 20% is an appropriate rate. Because for some reason 25% seems too fast of a rate of growth that's reasonably obtainable by a company over a period of, let's say, 10 years. And if we limit it to 15, we're limiting a lot of the really excellent growth opportunities that are out there. So when projecting your future earnings stream, I recommend you cap the future rate of growth at a maximum of 20% per year. Additionally, when we apply a multiple to the end of that earnings stream, so if we're projecting out our earnings over the next 10 years and we're applying a 20% growth rate, I recommend that you cap that multiple at a maximum of 20. So if you have $1 in earnings per share and it's growing out whatever over the next 10 years at 20%, whatever that future value is, when you're trying to determine a future price, I recommend that you maximally use a rate or a multiple of 20 at the end once you have that future earnings per share figure. In estimating the rate of growth to begin with, you always want to use conservative numbers. Personally, I like to look at what the revenue is growing at, what the earnings are growing at, and what is the remaining market share that the company can capture. Whichever one of those numbers will then limit one another. So revenue growth is almost always slower than earnings growth. And then ultimately that revenue could only grow to the size of the market that it's in. So if the size of the market is X amount, the revenue can only theoretically grow up to that amount. So what I would recommend that you do is you use revenue growth if it's slower, and take how fast the revenue's grown over the last 5 or 10 years. Take 25% off of that number and then use that as your growth rate. That will typically be a very conservative estimation of your future earnings growth. So take a situation where a company is growing at 15% per year in terms of its revenues, okay, and it's done so consistently over the past 5 to 10 years. I would apply a future growth rate on the stream of earnings of 12, which is 75% of 15. Okay, because chances are that the earnings have been growing substantially faster than the revenues over that same period of time. But we want to be conservative in our estimates. A good investment does not require us to be aggressive in our rates of estimated growth to justify it. So if the investment is good enough and provides us with an adequate margin of safety, we do not need to use extremely high growth rates, a maximum of 20. And for me to apply a 20% growth rate, that means I have to see revenues growing at 25, 26% or whatever per year consistently, right? And then only then would I bother, so the revenue growth has to be consistently high, way higher than 20% for me to apply a 20% growth rate, because I'm taking 75% of what that revenue's been growing at. Because revenue growth is already conservative compared to earnings growth, and then by taking another 25% off of it, I can be ultra conservative, and then capping that maximum number at 20 gives me a third level of protection for my future estimates of growth. So keep in mind, you do not have to be aggressive in choosing your growth rate to justify an investment. The investment should be good despite your conservative estimation of future growth. Keep that in mind. Thanks.